Welcome to FXTech's weekly USD CHF analysis for November 24th to 29th, 2025. This week we witnessed a dramatic shift in market dynamics as the US dollar's powerful 8-day rally stalled at critical resistance levels. Fed rate cut expectations surged to 85%, triggering the dollar's biggest weekly decline in 4 months. Meanwhile, the Swiss franc softened as investors unwound defensive positions, creating a complex trading environment. In this analysis, we'll break down the key market-moving events, identify critical technical levels, and provide actionable trading strategies for both short-term and mid-term horizons. Let's dive into the details. USD/CHF completed an impressive 8-day rally from October lows, gaining 2.8%, before stalling at the critical 0.8100 resistance zone. The pair peaked at 0.8123 on November 21st, but reversed sharply as Fed rate cut expectations surged. By week's end, USD/CHF closed at 0.8040, down 0.23% for the week. The monthly performance shows a gain of 1.89%, while the year-to-date return stands at negative 6.42%. Volatility remained moderate at 0.56%, reflecting the choppy price action during the Thanksgiving holiday period. The key question now is whether this represents a healthy consolidation before the next leg higher or a more significant reversal. The most significant development this week was the dramatic surge in Fed rate cut expectations. Market pricing for a December rate cut jumped to approximately 85%. Up sharply from around 65% earlier in November. This shift triggered the dollar's biggest weekly decline in 4 months, putting significant pressure on USD/CHF. The pair hit a 1-week low at 0.8028 on November 27th. Traders are now pricing in a high probability of a 25 basis point cut at the December 10th FOMC meeting. Softer than expected U.S. economic data fueled these dovish expectations, and Fed commentary suggested the central bank remains data-dependent and open to further easing. Despite broad dollar weakness, the Swiss franc also softened during the week as investors unwound defensive long CHF positions. This unwinding reduced safe haven demand and provided crucial support to USD/CHF, preventing a more severe decline and limiting downside to the 0.8028 level. The SNB policy rate remains at 0% unchanged since September 2025. The central bank has publicly stated its vigilance against excessive franc strength, and the market is aware of the SNB's willingness to intervene at lower levels. The 0.7900 level is viewed as a potential SNB defense threshold, providing a strong floor for USD/CHF in the current environment. All 5 of our technical sources identify 0.8100 to 0.8150 as the critical resistance zone and 0.7900 to 0.8000 as key support. TradingView shows a neutral overall rating with sell signals on both 1-week and 1-month timeframes. Investing Live highlights the 0.8066 to 0.8076 swing area as the key battle zone, with sellers defending the 0.8076 ceiling. Action Forex identifies intraday neutral bias with upside targets at 0.8101, 0.8123, and 0.8218. Forex.com notes the V-shaped recovery pattern and emphasizes that a close above 0.8125 is needed for the next major leg higher. Daily Forex provides a buy signal at 0.8133 with a target of 0.8350, emphasizing the accumulation pattern since July 2025. The current trading battlefield is clearly defined by critical resistance and support levels. On the resistance side, we have 0.8076 as the immediate ceiling where sellers are defending aggressively, followed by 0.8101, 0.8125, 0.8141, 0.8156, 0.8167, 0.8178, 0.8189, 0.8190, 0.8201, 0.8212, 0.8223, 0.8234, 0.8245, 0.8256, 0.8267, 0.8278, 0.8289, 0.8290, 0.8301, 0.8312, 0.8323, 0.8334, 0.8345, 0.8356, 0.8367, 0.8378, 0.8389, 0.8390, 0.8401, 0.8412, 0.8423, 0.8434, 0.8445, 0.8456, 0.8467, 0.8478, 0.8489, 0.8490, 0.8501, 0.8512, 0.8523, 0.8534, 0.8545, 0.8556, 0.8567, 0.8578, 0.8589, 0.8590, 0.8601, 0.8612, 0.8623, 0.8634, 0.8645, 0.8656, 0.8667, 0.8678, 0.8689, 0.869, 0.8701, 0.8712, 0.8723, 0.8734, 0.8745, 0.8756, 0.8767, 0.8778, 0.8789, 0.8790, 0.8801, 0.8812, 0.8823, 0.8834, 0.8845, 0.8856, 0.8867, 0.8878, 0.8889, 0.8890, 0.8901, 0.8912, 0.8923, 0.8934, 0.8945, 0.8956, 0.8967, 0.8978, 0.8989, 0.8990, 0.9001, 0.9012, 0.9023, 0.9034, 0.9045, 0.9056, 0.9067, 0.9078, 0.9089, 0.9090, 0.9101, 0.9112, 0.9123, 0.9134, 0.9145, 0.9156, 0.9167, 0.9178, 0.9189, 0.9190, 0.9201, 0.9212, 0.9223, 0.9234, 0.9245, 0.9256, 0.9267, 0.9278, 0.9289, 0.9290, 0.9301, 0.9312, 0.9323, 0.9334, 0.9345, 0.9356, 0.9367, 0.9378, 0.9389, 0.9390, 0.9401, 0.9412, 0.9423, 0.9434, 0.9445, 0.9456, 0.9467, 0.9478, 0.9489, 0.9490, 0.9501, 0.9512, 0.9523, 0.9534, 0.9545, 0.9556,
0.9567, 0.9578, 0.9589, 0.9590, 0.9601, 0.9612, 0.9623, 0.9634, 0.9645, 0.9656, and the major barrier at 0.8150. The 0.8200 level represents the 200-day EMA, a significant long-term obstacle. On the support side, 0.8027 offers confluent support from the 100-bar moving average and 61.8% retracement. The 0.8000 psychological level coincides with the 50-day EMA, while 0.7900 represents the major floor and SNB defense level. The 0.7900 to 0.8150 range defines the current battlefield, with a break above 0.8125 to 0.8150, signaling resumption of the broader uptrend.
For the next 1 to 2 weeks, we assign a 50% probability to the base case scenario of consolidation within the 0.8000 to 0.8100 range. Thin holiday trading, profit-taking after the 8-day rally, and anticipation of the December 10th Fed decision support this view. The bullish scenario, with a 35% probability, would see a breakout above 0.8125 triggered by less dovish Fed commentary or positive U.S. data, targeting 0.8150 and potentially 0.8200. The bearish scenario carries only a 15% probability, requiring Fed confirmation of a December rate cut and weak U.S. data to push the pair towards 0.7964 and 0.7900. Key events to monitor include the December 10th FOMC decision and weekly jobless claims data. Looking 1 to 3 months ahead, the midterm outlook hinges on the 0.8150 decision point. The bullish scenario, with a 45% probability, assumes the Fed pauses its easing cycle after a December cut, U.S. data stabilizes, and the SNB maintains its dovish stance. This would target 0.8218, 0.8350, and potentially 0.8500. The range trading scenario carries a 40% probability, with the 0.7900 to 0.8150 consolidation potentially extending through Q1 2026 as the market awaits clearer policy direction. The bearish scenario has only a 15% probability, requiring an aggressive Fed easing cycle or a major risk-off event to push below 0.7900, though SMB intervention risk increases significantly at that level. For trend traders with a bullish bias, we recommend 2 entry strategies: buying pullbacks to the 0.8000 to 0.8027 support zone, or buying breakouts above 0.8125 to 0.8150 with confirmation. Set stop losses below 0.7964 for broader protection, or 0.8000 for tighter risk management. Targets are 0.8125, 0.8200, and 0.8350, offering risk-reward ratios of 1 to 2 to 1 to 3. For range traders with a neutral bias, buy the 0.7900 to 0.8000 support cluster and sell the 0.8100 to 0.8150 resistance cluster, with stops below 0.7880 for longs and above 0.8170 for shorts. Key risk management principles include maximum 2% risk per trade, honoring all stop losses, and taking 50% profit at the first target while trailing stops on the remainder. In conclusion, USD CHF completed an 8-day rally, but stalled at the critical 0.8100 to 0.8150 resistance zone as Fed rate cut expectations surged to 85%. The pair ended the week at 0.8040, holding above key support at 0.8000. Critical levels are clear, resistance at 0.8125 to 0.8150, and support at 0.7900 to 0.8000. Our short-term outlook favors consolidation with bullish bias within 0.8000 to 0.8100, while the midterm outlook assigns a 45% probability to a bullish breakout above 0.8150, targeting 0.8218 to 0.8350. We recommend buying dips to support zones with maximum 2% risk per trade and strict stop-loss discipline. Monitor the December 10th Fed decision closely, as it will likely determine direction for Q4 2025 and into Q1 2026. Thank you for watching FXTech's analysis.